This conference will now be recorded.
Well, good afternoon. This is Bill Riley with Riley Gravitime, formerly this is Riley with the Backers. Decided to change the name, change a little of our marketing, and update the website to show more pictures of Ireland. That's kind of my favorite. And I'm Irish on both sides, so it's something I've been wanting to do, and I hope you enjoy it. What we're going to do today is talk our quarterly meetings and webinars to kind of discuss where we're on the market, where the concerns I have, outline some things that I see coming. With me a while, I never predict, I just observe and kind of see where think we might be going, what I think the concerns we might have. So if we go to the next slide, you'll see some of the topics we're going to talk about. Oh, and that's our family crest. That's authentic. If you ever came to my office, you'll see a picture of my dad, who's a true Irishman too. That's our family crest. What we're going to talk about is this: interest rates. Interest rates have really been kind of messing with the market a little bit. We haven't seen big increases in interest rates for a while. We're really not seeing them now. So I think it's more of a behavior, a little bit of fear factor that rates are going to take off at some point, and people are getting nervous. But we'll go into some charts later, and also go into some 5 areas that I see and kind of explain. I don't think it's as bad as we think it is. We're also going to talk about some market performance, the overall market performance, coming off probably one of the worst historic years I've lived through and struggled with, and where we are now and where I think we might be going. And then inflation. Inflation's here. Don't kid yourself. And we'll go into more depth on that. So let's start with the rising rates. Rising rates cause falling bonds. And really, I'm more trained as a technical type guy, so I watch charts. And what we're seeing with interest rates right now, which is on the 10-year, that's the benchmark, 10-year Treasury, is higher highs and higher lows. We go to the chart and I'll show it to you. This is as we start increasing rates, that's what you watch for. Is that, are we getting the higher highs, higher lows? I mean, they go up a little bit, they'll come down, but the next news is up. They go past where they were, and they don't go down as much. You're forming a base there for an increase in interest rates. Now, there's 5 factors that I kind of observed that are causing this. The first one, of course, is physical stimulus. Money supply, and that's in these subsidy checks, is putting a lot of what we call the volatility of money into the economy. So therefore, people are spending. What's interesting is I thought the stimulus checks were supposed to be for food, pay the rent, buy the kids clothes, but I heard some people are buying Bitcoin and going to Vegas. So I think the wrong people got the stimulus checks, but that's a political comment for me. But this constant flow of money, we got one coming, we're going to have another one. They're talking about all these other things. The more money you put into the economy, the more activity and buying of goods and services happens, so therefore rates will start creeping up. In the bad economy, rates go down, just like it did back during the pandemic when we dropped to 0.50 in the U.S. Treasury. Now, another thing is this unique monetary policy that the Fed has adopted. I spent my time with Greenspan, and we used to joke around and watch TV every morning when the Fed was going to meet. And we would kind of take bets. If the briefcase was real full, he was going to raise them. If the briefcase was pretty light, he was to keep them as they are. But Powell is more of a business person, and he's not going to tip his hand. But they made this kind of like pact, you call it, not to raise rates until they really have to. I'll talk about that a little bit. That may be a little bit dangerous if we get runaway inflation. Now, inflation has come back. We can't kid ourselves. I mean, lumber prices are 300%. Like you, I had some frozen pipes in the garage, and the gentleman that works on them, I live in a kind of European village, and the person that comes and fixes all of our stuff, he said, I have to just turn off the sprinkler systems. And because I can't even get sheetrock and elbow joints made out of copper to fix them, it'll be 4 or 5 days. So what that has in inflation is cost and supply and demand. Basic premise. If you have more demand than you have supply, then prices go up. And we've seen this with lumber. It's amazing how much lumber has gone up, almost 300% in a very short time. Now, one thing we don't want to have, I saw this back in the early 80s when Volcker was the head of the Fed, we had runaway inflation in carton. I mean, it was really runaway. My dad is still alive, and he ran several manufacturing companies, and it was very difficult for him because we had to buy raw materials and quote the jobs, and it was tough because sometimes the buying materials, if you didn't have them in the, buying at a good price, your margins dropped significantly. So it was a tough thing to go through, plus interest rates were 18-20%. So Volcker came in one Saturday night and decided that he's going to stop all the inflation, and he raised rates by 200 basis points. Now we get excited when it's a quarter or a half. You had to be there to see when he announced that on Saturday night. The market basically fell out of bed on Monday because that was something that just couldn't be absorbed. And I don't want to have to go through that. So I'm a little fearful the Fed's going to let this thing get away from them. Because inflation is funny. Inflation is one of those things that once it gets started, like a wildfire, it's hard to put out. And you have to take some drastic measures. Now, right now, the bond market is going through what I call indigestion. They're trying to raise so much money to pay for things. The auctions, they put these bonds out on an auction, and everybody bids them on. And they've got more supply that they can get rid of. And that's causing some disconnects in the bond market. For example, I saw the 7-year Treasury auction about 3 weeks ago, and nobody bought them. It's one of the worst auctions we've seen, because if you don't want them, nobody's going to bid them up. So we're seeing that effect of that. And that's causing a lot of rates to go up, because if you want to sell your 7-year and it's at a certain rate, to get it sold, you've got to keep raising the rate to get it bought. So that's a factor. The big factor is the key technical support of breakout levels. What's happened with bonds is that people are trading bonds. Now, they didn't trade them when they were, down 50 basis points, but now they are, because bonds work in reverse of stocks. If the bond if the bonds go to, like, say, 150, you can buy that bond at 150. Okay? If it drops like it has been, if it drops down to about 135, then you can sell your 150 at a profit. So what's happening is people are starting to trade bonds almost like they're trading stocks. Now, it's not as volatile as the stock market by any means, but we haven't seen that in a while, and that causes rates to start going up. What we're also seeing is a peak, that we're hitting these peaks and then backing off. And the thing is, the bonds aren't falling as far as they used to. They're kind of doing this higher lows. So therefore, we're starting to get this interest rate creep. But it's something we have to deal with. We had historically low rates. I would have never thought in my career, 40 years, I'd see the 10-year Treasury at that point. That's just, it's unfathomable. Because really what happens if you apply any matter inflation, then you end up with negative rates. They're artificial, but it's really negative rates. That means, you're paying them to buy the bond. And we've had that in Europe, and they've kind of figured out that didn't work too well. So that's what we saw. And it's kind of nerve-wracking to us that manage money, because You want to add some fixed income to your portfolios, and we'll go into that a little later, but you sure can't buy a bond right here, because if you were to have bought a 10-year treasury, let's say you bought it at 0.9, so there a while back, and all of a sudden that jumps to 150, that bond that you hold is worth, you'd probably lose maybe 50 basis points if you try to sell it, because why would I want to buy your 0.90 when I could go out and buy one for another guy for 1.5? So the only way to get it sold is to keep cutting down the price of the bond to raise the yield. And that gets pretty bad. One thing about bonds is that once they go down, they usually stay down and never recover. So what to expect next? Here's what I think will happen. I think the 10-year yield will continue to creep up. We'll have some times where it will go up to maybe 175, back off to 135, and then come right back up to 180. So we'll play this push me, pull me scenario for a while. But at the present level, if we get economic stimulus, which we are going to get, we get the volatility of money back in, we could very well see the 10-year treasury go through 2%, maybe 2.25%. Is that a good thing? In some instances, it might be, because it makes us realize that the economy is back on track and healthy. As long as it doesn't get past 3%, I'm not really worried about it. But if it starts approaching the 3%, then here's the trade-off. The yield on the S&P a year ago was about a little over 2%. The yield on the Treasury was way below 1%. So it was better to buy dividend-paying stocks on the S&P for income than it was the Treasury bonds. Well, just a short time ago, when bonds started creeping back up to the 1.7, 1.8, all of a sudden they became very close to being the same yield on the S&P. So it's people running the stocks like they did a year ago. That's what made the market go up, or part of it. Now they can kind of filter in a few bonds if they're willing to stand the volatility and get the same, pretty close to the same yield. So that's another thing that's causing this interest rate problems and the volatility in it, is the swapping out of one to the other, people trading bonds, which I haven't seen do in a while. That's where we are. Another thing is, on 4/22/20, we had people that were seeking income, like I said before, had to buy something like equity income type instruments if they wanted any kind of a yield. Now today, you can actually start trading bonds. That's what we've seen it. And this will persist. I think interest rates this time, the 40-year bull market is over, or the 30-year, they call it. The bond market is over, because interest rates keep coming down all this time. So if you had a nice bond at even a 30-year at 4 or 5%, if you could get them back then, that bond was worth some money, because you were getting a nice interest rate, and they were liquid. So to put this to perspective, the rise in the U.S. 10-year yield began early in August with an all-time low of 0.51. And since that date, the rate has increased 120 basis points. That means 120% basically by March the 18th. Now, remember, we have low interest rates. They're historically low. It's nothing like the 80s. I don't know if you remember the Carter years. I was on the desk still on CDs at 14%. And people were buying right and left. We already see that again. So we don't have this surge of very high interest rates, but it does still come into effect. Excuse me, when you're trying to model portfolio to invest money. I don't see it being a big factor. Like I said, until we get everybody past 3%. Now, the Fed has a lot of controls, and they can control that. Now, And I don't think we're going to be facing that for a little while. They're going to let the economy run hot here for a little while. They're not going to be raising on the short end. That's one thing they control is the short end of the interest rate. But the long end does have started having effects, and that's why I'm watching the 10-year, I'm watching the 30-year to see how these things are reacting as we go forward, as the economy reopens, people get jobs back, money starts flowing again, we see a surge in the economy, because a good economy means higher rates. It's just normal. I've never seen low rates in a good economy, or extremely low rates like we saw. It just doesn't work that way. So bonds will suffer with these actions. And what I want to talk about here is there's the old adage in retirement where you go 60% equities and 40% bonds. Well, in this case, that isn't going to work, because 40% in bonds, even if it got back to 2.5%, is not a very good return on 40% of your money. So what we're doing with the models is we're actually increasing equities to about 80%, 75, 80, and then the fixed income is comprised of corporate bonds with short time frames or duration and some credits, so that we can get a little bit better yield to play this out, or at least have some return on our money. So 60-40 is out for a while. Dr. Siegel with the Wharton School, which I follow a lot, has made that hard and fast statement. It's not going to work right now. So what do? I think that bonds are going to be probably pretty tricky to play here. I know with the portfolios that I'm running in this office, we have very little bond exposure other than some good corporates, some high yields, some credits, but treasury bonds just aren't there. Everybody says, well, buy TIPS, Treasury Insured Protective type, because they're supposed to go up if inflation goes up. The problem is TIPS lag, and you get caught in that. But, if you want to use those, you could. But still, the rates are very low. So you're not getting back to the buck. So when you add inflation on top of these low interest rates, it's kind of like, Slim left town and he's not coming back. It's not going to be a pretty picture, especially for people that are needing income. Now let's go to something I put in the notes earlier, and it's, the ticking clock. What is the ticking clock? Well, it's inflation. We haven't had inflation in 10 years. I haven't even factored it in to the models because there was basically no inflation. In fact, it's been the reverse. But now we're starting to see it increase, and I'll kind of go that a little deeper. The other day I filled up my car 2 weeks ago, and now I'm downtown for work, only 15 minutes from now, I don't fill up as much. But I filled the car up and I wasn't paying attention. I looked at my phone, I looked over, and I went, oh my gosh, it was $10, $15 more than it was the last time I filled it. Check the price, sure enough, gas is going up. I don't know how many of you remember $4 or $5 gas. That was a tough time, especially if you drove an SUV. Will we get back there? I don't know. We're very there's plenty of oil out there. There's plenty of that basic material, but I think that we are going to get some increases in gas, and that will cause, especially people on fixed income or that kind of thing, some pain. It can be fixed, but we have an administration, on our political ad, that doesn't believe that we should have the whole world should run on electric vehicles. And that's just not going to work. Not in Texas, but I think it will straighten itself out, and the demand will be there. It will drive up supply. But we can see, $3.5, $4 gas. That's the part of inflation that hurts. We'll also see inflation in just basic materials, because if the stimulus plan stays together, they do find out they need to spend money on building bridges and roads instead of some of the other stuff they want to spend it on. The basic materials that it takes to build a bridge, they're going to be paying more because of supply and demand. And there's a lot of work to be done. There's a lot of materials that have to be bought. Sheetrock prices, according to Lowe's, they price it almost daily. The stuff that's in stock actually goes up overnight. And we're going to see that. That's something we're going to have to factor in with this rebound in the economy as home building keeps going, as infrastructure keeps going. I mean, it'll get down to where, basic shovels will cost more because, if you're going to rebuild a road, you got to have a shovel. And that's why in my comments in the ad, you said you don't need a Zoom meeting, build a bridge. Well, maybe do a little bit, but I'm not going to, I take very seriously these guys that are out there, tearing up the bridges and rebuilding them are really going to be carrying around a Zoom camera. So we're going to go back to a different economy. We're going to go back to one where, hard assets, let's call it, if it fell under fluid breaking, it'd be like cement, steel, everything it takes to make a bridge, everything it takes to do a road, asphalt. And then in asphalt, you got to have oil. So a lot of these things will start coming forward. And there'll be a stimulus package very similar to what happened in FDR years when we had the WPA, and they put everybody back to work. Now, there's a good part of this in the fact that a lot of people, if you want a job, you're going to be able to find one. And it would be a fairly good paying job, even if you're long in the show. But there'll be a lot of jobs, a lot of these things. So money will start flowing. Money will get back into the economy. And things will look pretty good for a while. I'll talk about that in a minute, but we'll get a surge in this economy if they put it together and make sure the money's going to where it needs to go. So, ticking clock. You got inflation. That's going to be a problem. Something we have to deal with. But the other one is the debt. This debt thing is really bothering me because a lot of people have this misconception of, well, I got a stimulus check, but they never really think where that came from. It actually came from our taxes. And then we're out borrowing money to make up the difference. Our debt to GDP is not good. And as we look out over the next 2-year period, I think we'll have a good economy. I think the market will continue to go up. I think things will look pretty good. But at some point, you have to pay that back. And if you keep borrowing it the way we're borrowing, and if rates stay down like they were, it'll be good. But if rates start going up, remember, we have to service that debt, just like your credit card. If they raise rates on your credit card, your basic payment goes up. Same thing's going to happen here. So about 2 or 3 years out from now, if the economy doesn't grow fast enough for the tax receipts and the other things that happen to pay down that debt, then we're going to face some problems. Now, they're going to be serious. Well, it's not going to be a depression or a recession or anything like that, I don't think, because the economy will still keep going. But I lived through part of Carter's stagnation years, stagflation, we call it. And that's where, you have inflation, but you can't fix it because there's no way to fix it, not without taking some drastic measures. So what happens is that you can't raise prices to the end user, but you have to pay more for the goods, for the basic materials and labor. And labor is the one that causes stagflation. So then what happens is you're in kind of a flat economy. Nothing really happens. It doesn't go down much, it doesn't go up much. But in time, that starts eroding away the process of paying down the debt. So it kind of gets a little bit worse and worse and worse. Stagflation is very hard to stop because there's no real good fix to it. And it's caused by overspending, borrowing too much money, and lack of growth. One of the other problems is, as part of this thing, is taxes. I mean, we have an administration in there now that thinks by raising taxes, that's a cure problem. Well, it's not really. You start raising corporate taxes, but what they don't understand is the corporations, they pay a lot of the tax. A lot of them write laws, they have ways to get around it. But the real thing is they raise prices to what we're buying. They pass through it. So you kind of have this no-win situation. And this thing of going up to 28% on corporate taxes, all the job gains we've had, they'll start going away. Because if you got to pay more taxes, you can't hire more people, and that doesn't work. Should they go up some? Maybe. Should we have other types of taxes? Maybe. But I think a good, strong economy solves a lot of things. I mean, I'm not going to sit here and tout what's in the report, but basically, good, sound business practices and putting everybody back to work solves a lot of problems. So if you want to do something that's going to stop that, that's just going to exacerbate the problem, because it's going to be tough to, get a portfolio to do what we want to do. Next slide. Now we're going to look at these rates I talked to you about. As you can see, we took all the Clarion took this back. You see the picture there helping me back to 1220. So you look and you see what happened. We were up in the 10-year Treasury, a little less than 2%. Pandemic hits, and boy, there she goes. And it went down and flattened out all the way to 221, and we started our upward spiral. Excuse me, that is word. So when people say rates are going back up, rates are high, really nothing. It's about where we were when we started this mess last year. The problem is if we start getting these higher highs and lower lows, that's when we'll start seeing some effects of it. Go to the next slide. This is the 10-year Treasury over the last 12 months. And you can see that things kind of held steady. We were around we had these low rates, and then all of a sudden they took off again. And this is what's bothering the market. Markets don't like that. I don't like it because I can't really tell you how far this thing's going to go. I mean, I think it'll subside. We may be at the end for a little while on raising rates. When I came in here from my office, I think the 10-year dropped down to about 1.62, from being up about 1.74 days ago. So maybe we're seeing some relief there, especially as the Fed notes came out and they kept talking about that they're going to stay there. They're going to stick to their guns. They're not going to raise rates until they have to. And it has to be, really have to, according to Powell. He wants full employment. He wants everything back like it was, and then he'll consider it. And that may be that we won't get an interest rate, a big one, probably until 2022, and maybe late 2022. But he wants to see everybody back to work. He wants to see things going, and he's going to let this thing run a little hot, especially on inflation. Go to the next slide. Now, this is in the last 3 months. If you forget about the percentages on the left, that's the real world rates. I mean, the average rate on the 10-year Treasury is between 3 and 4%. So this is historically low. But if that was true, then you really get excited. The fortunate thing about this is we've had an increase, but we're only still about 1.6. So that's still not bad. We can handle that in the economy. That doesn't have a lot of effect. I remember in the 80s, helping Dad was running businesses, and I was, in this business. He struggled with it all the time because he was having to borrow money at 14-15% to, buy the goods and services, make all the stuff we made. Try to factor that into your business model. If you can borrow it at less than 1.5, that's not a bad deal. Profits are there. And it's not that hard to factor that in. But you start getting up there, it's pretty tough. Let's go to the next slide. Let's leave that on for a little while I talk about the markets. You can see in the last 15 months, the effects of the pandemic pretty shocking. We were down in some accounts. Well, actually, the S&P fell to almost 34%. And people don't understand that. I'll talk about that right here. I've had clients say, well, the market's way up. I'm not. I said, when did you get in the market? Well, they've been in the market for 2 years. You wiped up all of your profits during that period of time, in March, April. Now, to get back to even, what people don't understand, if you're down 30%, you have to go back up almost 60% from the bottom to get back there. And then I hear people saying, well, in the last now we're a year from this, okay? The market's up 39%. I said, that's from the very bottom, it's from down 39%, not in real world. So you have to take your time frames and look at this and consider, okay, when did I get in the market? When did I add more money to the market? And that kind of thing. But as you can see, we're back to about where we were when we started, a little higher. That's good. Basically, as of this morning, the Dow Jones is up 8%. S&P is up about 8%. The Nasdaq's lagging these last 3 months. It's only up about 6%. So, don't get excited here, because in December, we basically got back to even, as you can see, back around where we were. Then we kind of flattened out. The market hasn't done just a whole heck of a lot in the last 3 months. It's steadily climbed. So, let's leave that on the screen a little bit. Let me kind of talk here with some added notes. The old thing is, it's time in the market that makes money, not time out of the market. And we had clients here that, not very many, everybody kind of stayed in the upset. They got it at the very bottom because they didn't take it. And one of the things I want to lecture them around here, you need to look at what you own. And we had a client that owned Clorox, UPS, Amazon. And down, she couldn't take it, got hysterical, had to get out. And I tried to talk to her. She was like, I tried to talk to her. I said, look, you own some of the best stuff there is. You should be adding more money. I thought, she became really smart. How much toilet paper we sell? So you got to look at where you are and stay in, because this was an unusual thing. This wasn't like 2008. This was something that came out of the blue. I tell this story every time I call or do a talk, is that when this happened, I'm a historian and I keep a lot of select finance books. I make this joke. When this happened, the president closed down America. I tried to find a chapter to tell me what to do when you close America. Guess what? Nobody has one. There is no baseline to go back and say, okay, here's what you do. What they even do is just hang on and hope it all comes out. There's no use selling it there. But anyway, now we're back where we should be. Mark's healthy head back into it. Are we going to run into some problems? Yes, we're going to run into some problems. So about 2 years from now, we should be able to make some money. Let's talk a little bit more about infrastructure. I think that's going to be the thing that really gets us through all this. A lot of the things that happened during this chart really went up. We went up on things that really, in the real world, maybe we shouldn't have gone up on. We're talking about the Zoom camera. Zoom, some of those stock prices got way out there. They're still up there elevated. Now they're starting to come down. And that's one of the things that we're seeing is a lot of the action in the market over the last 3 to 4 months has been the switch from growth to value. Because if you're a good portfolio manager, you're looking at we're going to be 6 to 8 months from now, not next week. And eventually, the Pelotons, the Zooms, the Teslas, and so on, they got way out of line on price. So as we recognize that, we started buying things that had good value. and things we knew you were going to have for infrastructure. And guess what? Those are real companies. Right? John Deere's a real company. Caterpillar is a real company. But some of these things, some of these other stocks, like these media stocks, that you can do this, you can do that, you stream, you do all this wonderful stuff. I agree to use them. They're always going to be around. Is that a real company? I really don't know. But I know that Apple is. I know that, machinery stocks are, and the basic material stocks are. And that's where money's going to flow over the next probably 10 to 12 months. Once he gets this thing started, everybody will wait till summer. And there's a lot of opportunities there because you're actually seeing prices that are pretty well in line with where they should be. You're buying at the right price. Some of these high flyer tech stocks, I'm not talking about the big ones, but some of these things, I have this old adage when I talk to people is, I don't want to jump on the train and go up the hill. I don't want to jump in front of the train and get run over. That's what some of these high flyer stocks are doing. So you got to be careful there in all your portfolios. We're overweighting value right now. It's a little boring, but really there's some good prices there and dividends. That's another thing I want to talk about is that if these rates stay below this 3%, which I think they will for a while, the only way we're going to be able to get income is equity income, and that's dividend paying stocks. Well, the nice thing about dividend paying stocks, those are the value stocks. Those are the things it takes to be an infrastructure. And the yields are pretty good. And they're staying. Meaning the autos are looking better now. And the yields are good. And so you're getting paid while you wait, that thing. I know that's where money's going to start flowing. See, at any one time, there's only so much money in the market. In fact, as of last night, there is still $5.6 billion in cash as part of this money velocity problem we're having. Just sitting there, it's not been invested in anything because people are still feeling the pains of the pandemic. They don't really know what to do. And they're a little afraid to go into the high flyer tech stocks, and they really don't understand the value stocks. So that's why there's so much money on the sidelines. But eventually, like water seeking its own level, that will come back into play as we get more. And a lot of it's the vaccines. Everybody had a big deal the other night. They said they got about 19% of the American public with vaccinated. Well, I'll be happy when we get 40, 50, 60. I think that'll really turn the economy because it'll be a lot freer there. But that's kind of like where we are for the quarter. Be very careful on any interest rates. I would really review your portfolio to see what you're in. If you need to take a little profit, some of these high flyers, it doesn't hurt. Nobody ever gets mad if you take a and start looking at other areas of the market where money will flow. And that's where you should be putting your money right now. Plus, take a little dividend yield. It doesn't hurt anything. And you've got some pretty safe stocks. There's certain things that will be in this infrastructure portfolios that kind of working on that you have to have. It's kind of like Warren Buffett's mold theory. You got to have it. It's a mold. You're trying to take these guys out. Take for example the dirt moving equipment. There's basically only three. There's only three companies that really have good dirt moving equipment. So they're pretty good, and they're at a good price. So that's where I know that money will be flowing. We have an opportunity to really profit from that, really with reduced risk. Now I want to do a little commercial here. I'll do that. We have a system we put in that I was on the original thing way back when Aaron came up with this idea. We have a thing called risk lines, which we can take your portfolio, put all the holdings in there, and actually do a risk of how much risk you're actually taking for the return you expect. And it has all this historical data I mean, we should run it. What part of my portfolio will be affected if rates go up? What part of my portfolio would be affected if we had inflation? You know, there are certain sectors of the market that are dramatically affected by inflation. And, you know, we haven't had it so long, we kind of forgot that. But we can assess that and say, okay, here's the areas of your portfolio that we need to talk about. Because if this happens, this is going to happen. And then we can come up with a risk number that you feel comfortable with. So that I can tell you, okay, overall portfolio can go down 5%, but it has the opportunity to go up 10 or 12%. Can you live with that? Could you take a 5% hit? But I'll tell you right now, I can tell you that I got on the website, played around with it over the weekend, and saw some of the models, and they were doing a model of almost all high flyer tech stocks. You know what the downside is? 22%. I mean, some of these tech stocks and some of these high flyers have already dropped that much. People just didn't realize they're up so much that someone didn't really bother me and had a big profit. But that can continue on. But if it's in your portfolio, should you know that? Should your advisor say, hey, you know, you're making this hold right here, and you're holding this equity that does this. If inflation goes up, this is going to drop. And here's one that if interest rates go up, this is going to drop. Now, it may be you don't want to sell it, but at least you know. You know, it's kind of like I always use the little anecdote. You get an airplane, you're starting to take off. The pilot comes on, and he goes, at the end of the runway, they're doing some construction. So right before we take off, we're going to have a few bumps where I get this thing in the air. Well, everybody kind of relaxes. Okay, what if you didn't today? Think about it. He didn't say a word. Just about the time you're starting to take off, you hit all these bumps and things bumping down. You get a little excited. So what I work with clients or try to is go into these portfolios and say, here are the bumps. Here's what we look at it now. Is it going to be bad? No. But at least we know where it is. And do we need to, you know, rebalance the portfolio? Do we need to actually just get out of those if you're real risk averse? But you really need to know, you know, if this happens, how far could this thing go down? Now, the problem is, and I'll, you know, caveat ignore, but, you know, we had nothing in there about pandemics, guys, okay? We hadn't had one for 100 years. And back then, at the turn of the century, the stock market was still in its early years. So we had nothing to really base that on. But, you know, I haven't seen the models. They're still going through those models that think happen so fast. But I assure you that when we get our studies done, we're going to find out that if you held, you know, the things that you really need to get through the pandemic, the risk is pretty low. Even though it went down, it came right back up. But if you held some stocks, you were really in trouble. It came down and made up of it. So it's a little commercial. It's something that I stress in investing is know your risk number. Know how much, you know, you're taking with that. And the other side of that is called the risk premium. How much are you paying to take that much risk? And is the return worth it? You say, I want to make 22% returns, and you're going to have to take on some risk. Can you live through it? Can you live through the fact that it has to drop 15% to go back up to 22 or 22%? And look at that chart right there. If I told you, yeah, the market's probably going to drop about 32%, but if you just hang in there, it'll all come back. A lot of people couldn't do that. I mean, it was stressful. So let's wrap this up. We're right at our break point at 3:45. I hope this has helped some. So let's review the basic things I talked about. Interest rates are going to be an issue. And even though they're not historically high, psychologically, they will play. Inflation, it's not here yet, but it's coming. And the problem with inflation is kind of like a wildfire. Once it gets started, it's hard to stop. But I think the Fed has plenty of controls, not like in the 80s, that they can control it, but we're going to have to live with it. The debt factor is going to be an overhang. And at some point, that will come back to haunt us if we don't fix it. We don't find a way to fix it. Taxes, I just can't tell you that how, when I've seen some early models of the 28% corporate tax and what would happen, it's not a good deal. It could cause some unemployment problems. It fuels for inflation because you got to raise your prices. Corporations raise their prices to pay the taxes. So so we got 4 areas we got to watch out for. I think the next 2 years, I think it's going to be pretty good. Jamie Dimon, he came out and said, well, the next 2 years we got a booming economy. And he kind of saw what I saw, but big but. We get out there, we got some things we better address before we get there. Well, I hope you enjoyed this. I hope this was informative. I enjoy doing these, and we're trying to do them on a regular basis. Clary has set this up, and we can step in here and do one real quick. If something comes up we need to talk about, because one of the things I want to do with Writing Private Client, when we kind of went to that model, is more one-on-one, more information. So, you can feel more comfortable about investing and know what you know. Thank you very much. Now, do we have any questions, Claire? I don't see you hear me. Do we have any questions?
We haven't received any questions on the chat. I don't know if anyone wants to unmute themselves and ask a question.
Okay, well, we'll have this recorded. And if you want to have a replay, we'll have it on a link. But you can always email me or you can email Claire, and she'll send out those links. If you had some questions or you want me to review something, or you wanted a little bit more explanation on what we talked about. Thank you very much. I've enjoyed this, and I hope you did too. So have a good afternoon.